welcome back to the show. So in today's video, I'll be talking about the bear cases for all the tech stocks that I own in my portfolio today. So in today's video, we'll be covering three main things. We'll be covering the bear case for big tech, valuation for the tech stocks that I own, as well as some questions that you guys have left me in the comment section below. So let's talk about my holdings first. My holdings will mainly be these four companies over here. It will be ASML, Amazon, Microsoft, as well as Google. The three big hyperscalers are in here, as well as the biggest company in lithography. So let's talk about ASML first. ASML, they create these machines over here. These machines, they are about 2 stories high, and they take multiple different Boeing planes to transport from one place to another. And this is the product that they mainly sell to make billions and billions of dollars. So for ASML over here, this is their mode. ASML mode is their ability to not only create the EUV, but also the ability to assemble all the parts and to produce the machines that are the most cost effective and the machines that are of the highest efficiency. So if you're to look at ASML's competitive advantage as well, it is not only their ability to create something that is proprietary, it is also to increase the yield of all this semiconductor that is created from these EUV machines, as well as to lower the cost of each semiconductor that is created and all the different patterns that are printed using this EUV machine over here. So for ASML over here, this is their bear thesis. So ASML faces disruption risk from China. China has always been the biggest IP copier, and they will likely create a machine soon as well. So while this threatens ASML's share in China, their share outside of China will likely be unchallenged, because all these different other companies outside of China itself, like for example TSMC, Intel, Samsung, all of them have built their fabs around ASML's machine, meaning to say they built their fabs to accommodate ASML machines, and it will be cost ineffective for them to switch it over to all these China machines unless the Chinese machines can be so much more effective and produce so much higher yield that allows them to basically shift over. But it will take years for them to do that as well. And for ASML over here, they have existing machines that are currently operating as well. They are making a lot of money from that through their installed base management, where they just do recurring revenue of maintenance for all these different machines over here. So for ASML, China revenue now makes up around 27% of revenue, and they're guiding for between 44 and 60 billion in 2030 for their revenue over here. So let's say we take the 44 billion and then we make the China sales around zero. I computed the net income that they'll be getting from this, and it is around $11 billion of net income. So assuming a $29.3 of EPS with their shares outstanding, and assuming a 20 times earnings, ASML, the maximum downside in 2030 is $587. So what this means is if you buy the stock now, basically your downside is almost zero at this case. Unless the semiconductor industry goes into a depression, then I don't think buying now has any sort of downside. The only downside is opportunity cost. So for ASML over here, this is my summary. So China innovation risk is a very big problem. I've spoken to people who have some touch point with China semis, and they are extremely bullish on China's ability to create an EUV machine or an EUV alternative in the future as well. ASML is capital intensive and probably not a 20-year company to hold. So normally for stocks that you want to hold super long term, you want them to be extremely capital light, because if they're capital light, it means that they have a lot of different secular tailwinds. So for example, S&P Global, Moody's, they don't reinvest heavily into their business, and all they do is they can pump those money back to shareholders, which is what you want from your businesses over here. So for ASML, it is a company that is extremely capital intensive because they have to put in R&D and capex and to up their game in this space. So for me, I think ASML is a company, but it is not a 20-year company to hold. Next, I'll be talking about the hyperscalers, namely your Google, Amazon, and Microsoft as well. So for our hyperscalers over here, this is the capex. The capex has been overheating over the past few years or so. So this article is examining whether or not the capex is near its peak in 2025. So this is what the article has said. So this article has said that, as John Templeton once said, believing that this time is different can be one of the costliest ideas in investing. So why should we think that this AI boom is any different? So this research service and the cloud tracker shows that 5 of the top hyperscalers, Alibaba, Alphabet, Amazon, Meta, and Microsoft, are set to spend $350 billion on capex in 2025. This, of course, can be an exciting development, but our research also shows that capex spending is well above a long-term mean as a percentage of revenue, and a trend that could pull back very soon. So this is that comparison to the dot-com bubble over here. So technology investment surges are exhilarating and fun, just as the period of 1996 to 2000 gave us fun new things like web browsers, pets.com, amazon.com. Over-enthusiastic investors got over their skis, and the capital boom eventually slowed. Why should this time be different? I believe the AI investment boom is real and here to stay for at least the next decade. But just as the initial internet boom was met with a roller coaster of pullbacks and surges, this first stage of AI capital spending may be a dangerous point and due for a pullback. The internet industry reset from 2000 to 2002, but then later gave birth to the next generation plays like Google, Facebook, and its new search. Resets are good. I think we are ready for an AI reset as hyperscalers and technology investors reassess how much they are spending on AI infrastructure. The global trade crisis may be a catalyst. Enterprises are also in an early stage of evaluating their investments in AI and need the time to digest their results. The chaotic and unpredictable macro environment with seesawing policies on tariffs and global trade won't help this current situation over here. So next portion, he's talking about a pullback in cloud capex being rational. But still, we believe the capex is not sustainable over the next couple of years as additional factors weigh on the budgets going forward. So cloud revenue slowing, earnings are likely to be hit by accelerated depreciation of AI chips and tariffs and tariffs. So this is sort of like a summary of the statement that was made just now by this research paper over here. So the depreciation will hurt the income statement over the next few years. It is currently now hurting the cash flow statement because your free cash flow is your operating cash flow minus your capex. And so because the capex is extremely high right now, that's why the cash flow statement is being hurt. But in their earnings itself, the depreciation is normally delayed over a few years, meaning to say the depreciation for all the chips that they have right now is normally spread over the next few years. And so you will see the real effects coming in the earnings statement, in the income statement over the next few years or so. Currently, it's still not in yet. So if growth slows, all that overcapacity will hurt their earnings because if there's overcapacity and not enough demand for it, then there'll be accelerated depreciation of all these different AI chips over here, which are left to do nothing. So my belief is that spending is now their mode. Their mode now is their spending habit. So meaning to say no other company is able to spend 70, 80 billion dollars like they can. And because of all these different secular growth trends that we have right now, the demand is still strong. So for example, your automotive, your 6G, your migration to cloud, your machine learning, as well as healthcare, all these different portions, they are all using AI now. But the AI bear case is extremely real. It is similar to what we saw in the dot-com bubble as well. In the dot-com bubble, what happened was all your different telecommunication companies, like for example Cisco, they were building out all your different LAN cables without real use cases for them. It was only until after 2005 or so when we saw a birth of all these social media companies. Before then, there wasn't any use case for them, and they just kept building non-stop, which led to overcapacity and then eventually commoditization of their products. So for all your different hyperscalers today, we could see a similar story where they just spend and spend and spend, and then the spending doesn't contribute to return on investment on all these different capex spending over here. So this could hurt their earnings in the future, but currently the ROIC is still strong. When we see the ROIC number flipping, then that is where I will plan to sell all my different hyperscaler stocks over here. Next portion that I'll be talking about is specifically for Google, because Google is the company that is facing the most competition and the most risk to its moat out of all the different hyperscalers over here. So it is now called the dying company in the Mag 7. So for Google over here, it is facing competition from LLMs. LLMs are exponentially getting better by the day, and we are seeing multiple different LLMs coming up. So the argument is that LLMs will eventually take over Google's market share. And if LLMs take over Google's market share, then you will see Google search basically losing volume and losing ad revenue over time as well. So this is Brad Gerstner. He's basically arguing that Google is a dying business and Google is a company that we should be avoiding right now.
We didn't really debate it, but I was bullish Alphabet for the second half of this year, and you were bearish. I heard you on a podcast the other day. It sounds like you haven't changed your tune on Alphabet. What is your big concern? If you when you talk to shareholders in Alphabet now, is it that they don't have the lead position in AI and that all of a sudden search is going to get away from them, or is there something else? Because that likelihood seems really slim to me.
Okay, so Josh, here's my fundamental position. Search is going to be replaced by agent-led information discovery. I see it every day. My 15-year-old son says, Dad, I don't use Google anymore. I just use ChatGPT. I talked to 2,000 people at the Javits Center. How many people have used ChatGPT instead of Google over the course of the last 2 days? 1,000 hands in the room go up. I asked my analysts who are sitting on their desk. They're replacing their use of Google with ChatGPT. We are having a fundamental structural shift in how people retrieve and discover answers to the questions they have. So Google is going to have to compete in this new thing, okay? Meta's going to compete, Apple's going to compete, Microsoft with Copilot, ChatGPT, etc. There are going to be 6, 7, 8 incredible competitors there. Google will be one of those competitors. And let's assume that they're a very competent competitor because they have all of these assets. The question to you, what do you think the likelihood is that they're going to reconstruct as dominant of monopoly in this new thing as they have in search?
So
facing innovators' dilemma, facing the cultural challenges they have, I would just say as an investor, Josh, and I have a ton of respect for you, the discount rate that you need to apply to this investment is much, much higher today than it was 2 years ago. 2 years ago, there was no challenger. Google was the only game in town. Now we know search is being replaced with a new form of information discovery. And all I'm saying is even if they emerge as the leader in this thing, they will not have as much share of the pool of profits as they have in search. It's almost impossible for me to see how they replicate that. Now, I also have concerns about how they're operating the business, how they're slow in releasing products, the cultural challenges they have. I think they have challenges around the TPU versus the GPUs of NVIDIA. But I will stipulate that they get all of that fixed. I still don't think they can replicate the monopoly.
So basically what he's saying is that Google's moat is possibly weakening and Google search may be going to zero in the future. So if Google's other segments stop growing, then there'll be a real bear case for Google over here. So in terms of all your different LLMs, we saw the boom in 2023 as well as 2024 when people just hopped on all these LLMs. But now Google search itself in terms of the volume is growing. So that's not really a bear case for Google right now. So of course, if we continue seeing all these LLMs growing exponentially, then Google search, the volumes will decrease over time for sure because there's some portion and there's some form of overlap between your ChatGPT as well as Google search. So the bear case, if you're to assume an absolute worst case for Google over here, is Google search going to zero in about 10 years time. But currently now, I think it's a bit hard to see. If you're a Google shareholder today, I think the company is cheap. I'll talk about the valuation later on. So this is the earnings so far from all these different Mac 7 companies. If you looked at the earnings itself, I think the earnings were quite impressive amidst of all this tariff war over here. So Meta's earnings were impressive. Microsoft's earnings were impressive. AWS, GCP, all their earnings were quite good as well. And even Google search, they grew revenues by around 10% or so. So is their prices fair right now? So let's talk about Microsoft first. So Microsoft is a stock that is currently up year to date, surprisingly. And it is currently trading now at around a 33 times earnings over here. So this company is a company that is unaffected by tariffs, and my fair value for Microsoft is around $400. So currently now it's slightly overvalued after their earnings and after the acceleration from the earnings itself. So for me, I think I wouldn't add into Microsoft right now. I'll wait for it to drop below $400 before I start adding to my position. And my next entry for Microsoft will be around $340, $330. So for now, I'm staying out of Microsoft. I'm not adding, I'm not selling. I'm just holding on to my position. Next one is Google. Google is extremely undervalued. So this company over here is still trading at a 19 times earnings. And for Mac 7 company trading at 19 times earnings, when the stock market is trading at around 25 times earnings, it's just ridiculous. And my fair value for Google is around $190 to $200 a share. And the multiple that I think it should be deserving of is around a 24 times earnings, assuming the ROIC metrics and all your different calculations over there and the quality of the business itself. There's no reason for this stock to trade at 19 times earnings. It should be trading at around 22, 24 times earnings, which is more reasonable. And it is still low at 22 to 24 times as compared to the past. Next one is Amazon. So Amazon is currently a stock that is trading at around a 30 times earnings post earnings. So this company is trading at its lowest valuation in the past 10, 20 years or so. And currently my fair value for Amazon is around this price, so around $190. So my next entry for Amazon will be around $150. That will be where I'll be adding into Amazon again. Hopefully it reaches there this year so that I can add to my position. Last portion, I'll be talking about some questions that you guys have left me in the comments below. So the first guy over here, he said, hi, would you say that Berkshire stock is a good buy right now? Currently considering swapping out my Apple stocks with it. Time horizon is a long-term 10 plus years. So Berkshire is a company that is able to yield around 10% every single year. I think it's a company that will give you 10% stable capital gains every single year also. But if you're to look at Berkshire's buybacks and Berkshire's price to book itself, the price to book is on the high end, and the buybacks from the company has stopped completely since Q2 of last year. So they clearly know that the stock itself is currently overvalued, and that's why they're not buying into it. So I don't think swapping a overvalued company for another overvalued company is a good idea right now. I would sell my Apple stake and look for opportunities elsewhere. Berkshire is a company that is not extremely cheap. It is not extremely overvalued. It is somewhere hovering between the fair and the overvalued range. So for me, I don't think Berkshire Hathaway is a company that will be actively investing into it right now because the returns are simply not there anymore for this company at this price. Next comment over here, I'd be selling more Apple. There's definitely going to be some form of profit short from relocating production and changing supply chains, and they may not be able to get all their production machinery back as well. So I agree with this statement. Apple is a company that is facing a lot of headwinds in terms of your tariffs, and we're also not sure whether Berkshire sold their Apple holdings, and we'll be seeing it in Q1 of this year in May 15 when the 13Fs come out. So for Apple over here, it is currently a company that is facing two headwinds. Number one, it is not growing fast enough. Number two, the valuation is simply too high. So this company is trading at around a 30 times earnings, growing earnings at around 5% every single year. I think paying a 30 times earnings for a company that is growing at 5% is simply just a ridiculous price to pay. And yes, this company is predictable, but I don't think paying a 30 times earnings is anywhere justified. And that's why we've seen Warren Buffett selling and more than halving his share just a few quarters ago. So for me, I think I agree with this statement. Apple is a sell today. I'll be selling this stock if I owned it today. Last one, what's going on with United Health? It hasn't stopped dropping from a darling to a hated company. So United Health, if you don't know what happened, they released their earnings around a few weeks ago, and then the stock has just been dropping every single day. So this company over here is trading at 30% below the price before its earnings itself, and it is currently now trading at around a 17 times earnings or so. So for United Health over here, I think it's a quality business. It is a company that is simply just indispensable in the US itself because the regulators, they are more concerned with all your different policies and all your other problems in the US itself, including the economy. I don't think they will dabble so much into the healthcare insurance space because it will take a lot of money and it will take a lot of problems for you to go and solve this healthcare insurance problem in the US. Healthcare in general is just overpriced. So for United Health over here, it is the largest insurance provider in the US itself. And so for me, I think United Health will simply just survive this one. You will look back in a few years' time thinking to yourself why you didn't buy United Health at this price. Hopefully you guys have found this one useful and invest safe.